Media Statement. August 1, 2025. IRC welcomes end of Ramu Nico tax holiday, but flags concerns over expansion timing and industry-wide tax avoidance patterns. The Internal Revenue Commission (IRC) welcomes the recent announcement by Ramu Nico Limited that it will commence paying corporate income tax in 2026, following the conclusion of its long-standing tax holiday. This milestone is a significant step toward fiscal accountability and resource revenue sharing, and the IRC looks forward to working constructively with the company to ensure full compliance with Papua New Guinea's tax laws. Timing raises red flags. While the IRC acknowledges and welcomes this development, it is also concerned about the timing of Ramu Nico's newly announced 4.2 billion kina expansion, just as its corporate tax obligations are about to begin. Commissioner General Sam KOIM stated, "This sudden move raises legitimate questions. There is a troubling pattern emerging in the resource sector, where large-scale expansions are announced right when tax holidays end, effectively resetting capital recovery clocks and pushing tax contributions further into the future. These are a result of aggressive tax planning that we pay little attention to in plain sight, and two instances are pointed out here to highlight this point. The hidden cost of overlapping concessions. The first case concerns Ramu Nico, which was initially granted a 10-year tax holiday from 2006 to 2015 to assist in recouping capital costs during the construction and early production phase. However, this was granted in addition to generous capital recovery allowances already provided under the Income Tax Act, particularly the 10-year allowable capital expenditure (ACE) regime. This overlap in tax incentives created a redundancy that significantly eroded the country's potential tax base. From 2006 to 2015, Ramu Nico claimed deductions under allowable capital expenditure, and once its export volumes exceeded the 90,000-ton threshold, in 2015, as specified in the amended mining development contract, it triggered the formal tax holiday, which then extended from 2016 to 2025. As a result, the company has operated for 2 decades, from 2006 through to the end of 2020. Without paying a single toia in corporate income tax, despite extracting and exporting vast quantities of high-value nickel and cobalt. Now, as the tax holiday expires, the announcement of a multi-billion kina expansion threatens to restart the tax clock again. This could once again delay any substantial tax contributions from one of the country's largest mining operations. A broader sectoral pattern. This is not an isolated incident. The IRC has observed similar behavior across the resource sector, where project operators exploit loosely regulated incentives by launching new projects, expansions, or additional drilling activities that restart capital deduction timelines and perpetually delay tax payments. Another case in point, PNG LNG. The PNG LNG project is another prominent example. After nearly a decade of capital recovery from 2014 to 2024, under the allowable capital provisions of the Income Tax Act, another provision was inserted, a bespoke provision that accelerated another round of amortization for an additional 5 years commencing this year. Now, some partners are making further claims to extend amortization on costs that, from the IRC's assessment, have already been fully recovered. Scrutiny of Infrastructure Tax Credit Scheme. In addition to tax holidays and capital deductions, the IRC is also tightening scrutiny over the Infrastructure Tax Credit Scheme. In recent years, several projects submitted under this scheme have shown inflated costs or questionable valuations. While taxpayers incur the expense up front, the corresponding tax offset reduces their tax liability. IRC now applies tighter controls to ensure these credits reflect fair market value, and that taxpayers do not use inflated project costs to overstate their tax credit claims. This is still public money, just in a different form. We will not allow inflated contracts or related party schemes to distort the tax credit system, KOIM emphasized. IRC's position: investment is welcome, but tax evasion is not. The IRC reiterates that it is not opposed to investment or genuine reinvestment in PNG's economy. Responsible corporate behavior, sustainable development, and job creation are welcomed and encouraged. However, tax incentives must not be manipulated into indefinite exemptions from tax. Going forward, all expansion-related capital expenditure claims, including by Ramu Nico, will be subjected to rigorous benchmarking and expert valuation. EIIRC will deploy specialists in engineering, mining, petroleum economics, and valuation to determine whether declared expenditures reflect real market value. Any claims that fail to meet the standards of economic substance or fair arm's-length pricing, including industry-wide practices undermining national interest, will be challenged and denied. The era of unchecked tax concessions must end. Papua New Guinea is rich in natural resources, but its people will only benefit if the revenue generated from those resources is fairly and transparently shared. The above scenarios are the result of fiscal design weaknesses and uneven contract terms that favor developers over the state. Papua New Guinea has foregone billions of keenness in potential revenue due to these arrangements. KOIM warned, "The devil is in the detail, and the cost of overlooking these details is borne by the people of PNG." Mr. KOIM urged those who are at the forefront of the state negotiating team negotiating mining and petroleum projects to be conscious of the details in the term sheets that give unfair advantage to the developers. No more hiding behind obsolete practices. As global extractive industries modernize, increase automation, and reduce production costs, it is no longer acceptable for large multinational companies to claim that their operations remain so capital-intensive that they require decades of tax relief. Such claims fly in the face of commercial logic and modern mining realities, said KOIM. We will no longer accept tax strategies based on outdated assumptions and creative accounting, encouraging responsible tax behavior. Despite these concerns, the IRC commends the growing number of resource companies that have begun paying their fair share of taxes. This signals a positive cultural shift, one that recognizes tax compliance as more than a legal obligation. It is a moral responsibility to the people of Papua New Guinea. The positive behavior is also a reflection of some of the compliance enforcement actions that the IRC has undertaken in the extractive sector for the first time in recent years. The IRC calls on all players in the extractive sector to adopt a long-term view, one grounded in transparency, fairness, and national development. Conclusion: a call for partnership. Papua New Guinea's natural resource wealth holds vast promise. But that promise will remain unfulfilled unless those who profit from our land also contribute to its progress, not just through rhetoric and community projects, but through real, measurable, and timely tax contributions. Ends. Authorized by Sam KOIM, OB. Commissioner General. Commissioner General,